Hello everyone, today's video is all about purchasing own shares, specifically when a company buys back shares from one of the shareholders. So this is an option to consider for director shareholders who are looking to exit the business as part of a whole range of different exit strategies. One possibility is, let's say you've got three individuals in business together, director shareholder A, B, and C, and A wants to retire. So B and C could buy out his shares, but B and C aren't cash rich. They haven't got a lot of cash personally. However, the business is doing rather well. A lot of cash sat on the company balance sheet, a lot of distributable reserves on the balance sheet. So one option would be for the company to buy back the shares from director shareholder A, not B and C personally buy them out. The end result, of course, is the same insofar as B and C go from owning a third of the company to 50% each, and A is out of the game. He's gone. So, in terms of the tax, which is obviously very important in all of this and any exit from a business, from a tax standpoint, director shareholder A should be indifferent as to which option they go down, whether or not he receives his proceeds for the sale of his shares, whether it be from B and C personally or from the company. He should be indifferent because capital gains tax will apply either way. However, there is some caveats to talk about when the company buys back the shares. But in effect, if you get everything right, he'll pay capital gains tax. He will pay entrepreneur's relief if he's been there long enough, which assuming he is, and he's got the requisite 5%. Well, we know he's got 33%. So it'll tick the boxes for entrepreneur's relief. 10% on the first £1 million of gains, and then the default CGT position of 20% on any gain thereafter. So director shareholder A, he doesn't care. However, if the option of B and C buying him out personally, that is pretty much cut and dry for capital gains tax. You know, he will get the entrepreneur's relief. However, for the company share buyback route, there are a few certain hoops that have to be jumped through in order to secure that capital gains tax treatment. Because obviously, what he doesn't want, this is director shareholder A, is to be hit for tax in excess of the capital gains tax, and including the entrepreneur's relief, which can happen if you get it wrong. So what I mean by that is the certain tests when we do a company buyback of shares for the selling shareholder to get his favourable CGT treatment. He has to have been with the company for at least 5 years. So that's the first thing. He has to have a material disposal of his shares. So he doesn't have to sell out all of them. Often people do, but he has to have a serious reduction in the shares of his current shareholding to get the capital gains tax treatment. It has to be done for commercial reasons. This can't be part of a tax arrangement to save tax, and various other one or two other bits of things that you have to think about in order to secure the capital gains tax treatment. But basically, it's a pretty good way of funding a buyout for one guy when there are several guys who are director shareholders. Assuming that B and C want to carry on, they're not looking to sell the whole business. A, B, and C get out together by selling to a third party. So, it's basically A's maybe of a certain age. He's older than B and C. He says, look, I want to come out. B and C say, right, we haven't got enough funds personally, but you know what? The company's pretty flush. So the company buys the shares off A. And like I said, to go through these certain hoops, including the 5-year rule that he's been there for 5 years, material reduction in his shareholding, then he should get the capital gains tax treatment that he wants. Because if he doesn't, then he will be taxed as if it was a dividend. Now, dividends, you pay a rate of 33% if you are a higher rate taxpayer, jumps up to 38% if you're an additional rate taxpayer. So if he's selling out for a few $100,000 at least, he's going to be an additional rate taxpayer. 38% on the dividends is no good when you compare with Entrepreneurs Relief, which of course is 10% on the first million and then 20% thereafter. So you want to avoid being taxed as if it was a what we call a dividend distribution. So make sure you've got to go through all these steps. They're relatively straightforward to do. I mean, the obvious one is has Director Shareholder A been around for at least 5 years? That's the one where you can't do anything with it. It's he either has or he hasn't. And if he hasn't, then wait a few years to explore that particular option, or do one of the other options that I've talked on in different videos of exiting from a business. But the company share buyback, so the company buys his shares and cancels those shares, so that let's say you had 100 shares in existence and you had 33, 34. He was the guy with 34. The company buys back his 34, so now you have in issuance you have 66 shares, and B and C own those 33 each. So that's 50% each, and it's a relatively straightforward process. However, I would recommend that you, if you were planning on doing this, you obviously speak to a tax advisor first, as I said, just to make sure those it's not a long list of hoops to jump through, but there are certain things that you don't want to get wrong. Make sure you're doing those right. And to be on the safe side, you can even apply to HMRC for advanced clearance and say, look, this is what we are proposing to do. The company wants to buy back the shares of an exiting shareholder. This is the plan. Can you give us assurance that this will qualify for capital gains tax treatment and not be taxed as a deemed distribution, i.e. taxed as if the shareholder had received a dividend, which is like double the tax, at least double the tax. So just a few practical things. You would need enough distributable reserves in the company to be able to do the share buyback. So what does that mean? Well, that's the figure at the bottom of your balance sheet, which is your accumulated profit and loss account, which is in the shareholders' funds part of the balance sheet. There needs to be enough of that to fund the purchase price. So let's say Director Shareholder A's shares were worth £1 million. You would have to have £1 million of reserves to do it. Now, remember, reserves is not the same as cash. So cash is at the top half of the balance sheet. Reserves is something else at the bottom. The company law dictates, the rules are that you have to have enough reserves. So let's say you've got £1 million of reserves. However, the cash isn't as strong, so the cash could be nowhere near. There's no reason why it should match the reserves. Cash could be, let's say it's $750,000, $500,000. So on paper, legally, the company can buy back the guy's shares because there is enough reserves, but the cash isn't there. So what would happen is, technically, you would do what we call deferred buyback, deferred consideration. So in effect, there is one contract to buy the guy's shares for £1 million, but the company does it in stages. So it says, right, we'll pay you 300 grand now, we'll pay you 200 grand after year one, 200 grand after year two, and so on until it's paid him the million, all to be negotiated amongst the company, B and C directors, shareholders, and A who wants to exit. Now, the crucial thing with that is that again, it's all about the paperwork on these deferred deals. You are from a capital gains tax point of view, you are out. You are selling of your shares at day one, even though you're not receiving the full consideration for could be several years. But from a tax point of view, that's your gain accrued on day one. Now, of course, what you don't want is what we call a dry tax charge. So let's say on that example, the guy sells for £1 million. It will go on his tax return. Let's assume he's jumped through all the other hoops to get capital treatment, Entrepreneurs Relief 10%. So that's 100 grand of capital gains tax, which will go on his tax return, due in on the following January from the year that they did the deal. But of course, he might be paid out on the drip. So obviously, you want to avoid a dry tax charge. Now, dry tax charge meaning you haven't got the funds to pay the tax. But in that example, he's getting the million over several years, but he could be getting a couple of $100,000 each year for 5 years, or 300, 200, 100, whatever it is. Hopefully there should be enough of that upfront payment to cover the tax, especially if it's only 10%. So we've seen that example, $100,000 capital gains tax due on the lot, even though he's not going to get the million for a while, but hopefully he's going to get at least $100,000 to pay the tax by the due date, and then of course for the several years after that he gets the rest of it. So that's another thing to think about, is the timing of the funds if you are going to do a deferred buyback. So it's just something else to consider for director shareholders looking to exit as part of a whole wide range of options, from management buyouts, management buy-ins, trade sales, individual shareholders buying out if they are personally flush with cash, or indeed listings, flotations, and also the employee ownership trust route as well, which I've done a video on recently. But this was just an overview of the company purchase of own shares, as it's called. Great for getting rid of a single shareholder director looking to retire when the company has the money sat in its coffers and the other shareholders don't necessarily have that personally. So if you do like this video, please do subscribe right there, and I will see you soon.